Good morning. Welcome to the Teachers Retirement System of the City of New York's investment meeting. Today is February 6th, 2020. Patricia, will you call the roll, please?
John Adler.
Here.
Thomas Brown.
Here.
Natalie Green-Giles.
Here.
David Kazansky.
Present.
Russell Buckley.
Here.
Deborah Penny.
Here.
Susanna Vickers.
Here.
Bill Quorum.
Thank you, Patricia. Okay, so we have a public agenda, and just for clarification, we're going to have our public agenda meeting. We'll go into executive session, and then when we go back into public meeting, we're going to add an emergency discussion of a budget item and a resolution that will be added. Okay, Robin, ready to start passport funds for December?
Great. Good morning, everyone.
Michael.
We will maybe begin with a quick recap of what the markets did in December and how the passport funds performed. So everyone should have that report handy. At the end of December, you can see the assets in the Diversified Equity Fund were about $16.2 billion. And you'll recall that the structure of this fund includes both U.S. and non-U.S. markets. As a reminder, the U.S. equity market was up about 2.9% in December, so it was a really strong month for U.S. equities that brought the calendar year return to just over 31% in 2019. So really strong market. Abroad, we saw similar numbers. So the EFI equity markets, developed non-U.S. in December, they were up about 3.3%. And again, quite a strong one-year number, up over 20% for developed markets. And then in emerging markets, December was really notable month, up over 7.5%. And for the calendar year, emerging markets up just shy of 20%. So again, really strong environment. What did that mean for the passport funds? You can see in December, the Diversified Equity Fund was up also a little over 3%, outpacing the hybrid benchmark by a few basis points. The calendar year return for that fund was up 28.05%. So again, lagging the hybrid benchmark by about 62 basis points for the calendar year. The underlying components of the Diversified Equity Fund, you can see the defensive strategies composite last year was up over 21%. That was a little bit behind, a few percentage points behind its custom benchmark. The actively managed composite last year also generated returns of about 26.8% versus the Russell 3 up 31. And the international equity component of the Diversified Equity Fund was up over 22% with 22.8% return, and that outpaced the custom benchmark there. Sorry, was there a question? Okay. The balanced fund, again, comprised of both global equities and fixed income. That fund was up over just shy of 11% last year with a 10.8% return, and its benchmark up 11.4%. The International Equity Fund, which I noted, the composite of the Diversified Equity Fund, this is, you'll recall, a mirrored strategy. That fund has assets of about $184 million. December with a strong month, up over 4%, calendar year-to-date return of 22.7%. The Inflation Protection Fund, with $75 million in assets, last year was up 10.6% versus its benchmark of 11.2%. And the Sustainable Equity Fund, with assets of about $255 million, last year all told returning about 24.3% versus the custom benchmark, which was up 33.3%. Any questions on December or 2019? And we can review 2019 a little bit more as well when we present the quarterly report at the next meeting.
Okay, thank you.
So January, fast forwarding ahead a little bit, January was a bit of a more volatile month. You might actually recall that as recent as last Friday, the markets sold off quite a bit. A lot of that to do with headlines and concerns around the coronavirus in China and spreading more abroad. So January ended up being a negative month for equity markets across the globe. The U.S. was flat to negative by about 11 basis points. You can see that return for the Russell 3000 index. Just below that, the second line item here, the international composite benchmark, down about 2.5%. If you break that apart a little bit and you look a little bit toward the middle of the page, you can see the EFI index was down 2.1%. Small caps were down just over 3%, and emerging markets down about 4.7%. If you looked at the defensive strategies benchmark, you can see during the month of January, rather than protecting on the downside, they actually outperformed. We'd expect a positive return of about 1.3% for that composite. What we saw in the US, a little bit more notable, not so much notable that growth outpaced value in January, which we'd seen quite a bit for a while we've been talking about, but low volatility stocks, which make up a good portion of that composite, did especially well in the month of January. So we'll see that trickle into the performance of the diversified equity fund. You can see the diversified equity fund's hybrid benchmark down about 45 basis points for the month of January. Below that, down toward the bottom of the page, you can see we added a couple additional data points. We added, given the launch of the 2 new passport funds on January 1st, the underlying index funds for the US equity index and the international equity index passport funds. I'll just comment very briefly. The broad US fund was down in line with the US markets, about 13 basis points, and the international equity index down about 3.3%. Maybe I'll just comment very briefly because we have seen some volatility. I commented about Friday being a particularly negative day in the markets. This week we've seen actually a very strong few days for equities, especially here in the US. In fact, the S&P we're in the middle of the strongest week the S&P has had in 8 months. So again, the day by day, everything seems to be quite different, quite a bit of volatility, but all told, the market continues to hum along.
Thank you. Okay. All right, so we're ready for the discussion of strategic asset allocation. Roxanne will start that.
Yes.
Okay, thank you, Robin.
So, do you need this?
I was going to suggest, I don't know if we want my mouse.
Sure, yeah.
So, you want to do Susan?
Great. So this is a continuation of a discussion that we've been having with the board at the last several investment meetings. And specifically at the January meeting, we presented asset allocation output that included both Rokatan's capital market assumptions as well as assumptions that reflect more consensus-based views for U.S. public equity markets. Specifically, what we did was we received from BAM the average of all the consultants for the New York City retirement system, excluding Rokatan, and we ran analyses using those assumptions as well as Rokatan's assumptions, which particularly for U.S. equity are less optimistic. The board's response following a discussion was to request that both Rokatan and BAM develop some alternative portfolio mixes that would represent interim steps between the current target allocation and the initial recommendation that we presented, which called for a reduction of U.S. equities in aggregate of about 6.5 percentage points. So what we have on slide 3 is the result of that work that BAM and Rokatan have collaborated on, and my colleague Joe Nancroft, who you've met before and who is head of our asset allocation effort at Rokatan, is here to answer any questions you might have on this. But let me just describe what we've included on slide 3. So on slide 3, you have 5 columns. The current policy targets are the far left, so you're familiar with those, you've seen those before. The initial recommended policy targets are at the far right. That was what was discussed in the January 6th investment meeting. In between the current policy targets and the initial recommended policy targets are three alternatives that are sort of a step function. They take they step from the current policy target and reduce U.S. equity by increments of about 2 percentage points until we get to the original initial recommended policy targets. So we have 5 different mixes on slide 3. Let me tell you what's at the bottom of slide 3. At the bottom of slide 3, what we show are expected compound returns over the next 5, 10, and 30 years for each one of these mixes, as well as the expected risk measured by standard deviation. For each one of these portfolio mixes, we've developed expected risk and return over these 3 different time periods using both the original Rokaton assumptions, so those are the assumptions that include a relatively modest expected return for U.S. equities. And then we use what we call the adjusted expectations, which reflect the consensus of the non-Rokaton consultants for the New York City retirement system. And so, as you would expect, in each case, the adjusted returns looking forward for these different portfolio mixes are slightly higher than the Rokaton expected returns. And in some cases, they are pretty materially higher at a total portfolio level of about 100 basis points. So let me also note that in each case, we have added a statistic which is a contribution to the basket clause. You see that line under the total portfolio allocation. And just to remind everyone that this is a pretty significant constraint that we have to operate within, which limits the extent to which we can reallocate U.S. equity assets. So, Mike, is there anything you'd like to add?
I think you summed it up well. I turn it over to Joe to go through the.
Sure. Well, I think Robin's covered most of the content that's on this slide. The one thing that I'll just highlight, which is certainly implicit in the recommendation we're making, but I'll just call it out specifically, and that is the Sharpe ratio we have on this page as well, which is one measure. There's not only one measure of risk-adjusted return, so it's a return measure divided by the risk. And I think so it's a way to gauge how much return we expect to get for a portfolio relative to the risk that we're taking to get that return. And for all the recommended, the alternatives we're looking at, there's an improvement in that Sharpe ratio. Higher is better, so we're improving the Sharpe ratio relative to where we are today with the current target. And it's inherent in what we're recommending essentially, is that we're trying to, as much as possible as investors, trying to tilt the portfolio to improve risk-adjusted return. We're always taking risk as investors, but in this case, we're trying to most intelligently, given the market conditions, take risk. And that would be true with either. I mean, there's less improvement, but still some improvement with the adjusted assumptions.
So just to remind everyone, the theme of all of these portfolio mixes is one of reducing risk taken in global equity market, public equity markets, but most notably in the U.S. equity market. And these are, as is always the case, not sweeping changes, but we are charged with the task of looking at both current market conditions and long-term expectations, and recognizing that while we're not trying and could not, in fact, be tactical investors with a portfolio of this size, we are trying to make prudent recommendations in light of current market conditions, which for equity markets, we think calls, and in particular for the U.S. equity market, we think calls for a reduction in the level of risk taken in that asset class. In all these portfolios, we see a reduction in US equities and an increase in investment grade fixed income. And that continues to be the joint recommendation of Rokaton and BAM, that the board consider reducing exposure to US equities and increasing exposure to investment grade fixed income to a moderate degree. We are comfortable with all of these portfolios because they move us in that direction of reducing risk exposure in a modest way, but an important way, because anytime we take action with regard to this portfolio, we're moving billions of dollars.
Robin, can you
Yes.
remind me, does anything investment grade fixed income go in the basket? It's all basket for you.
Yes. There are modest changes to other asset classes, whether it's opportunistic fixed income or high yield, but the meaningful change again is reduction in US equity and increase in investment grade fixed income.
And it is still the largest, by far and away, the largest allocation in the portfolio. So we're
US equity.
the U.S. equity, we're diversifying the portfolio somewhat by moving some money out of the largest line item and into other asset classes. So there's still a significant amount of capital allocated to U.S. equity, and risk and return we expect to generate from U.S. equity, but we think that at this point in the market cycle, and given market conditions, it's prudent to diversify into other asset classes to try to find other ways to generate return and manage the portfolio risk from this point forward.
And then I would add, are we meeting the objectives that Robin laid out? Are we being prudent in light of the current market? And I think you can see that quantitatively if you take your eyes to the results of the current policy, the first column. So that's your actual portfolio today, and running that through the current capital markets assumptions, both Rokaton discretely as well as the other four, and you look at the expected risk and the expected Sharpe ratio in that first column, and compare that to any of those portfolios, you are seeing both a reduction in expected risk and an increase in expected Sharpe ratio, without a whole lot of degradation of expected return. And I think that's where we both get comfortable with either of these any of these options. I think we have a lean towards one, but it's kind of accomplishes the major goals of what I think is important to the decision making that needs to get done.
Can I have your name?
Mike Haddad, Haddad.
So Mike and Robin, so if we went, so no one has a crystal ball and we certainly don't know what's going to happen, but if we chose something that's moderate like the alternative two, we're still meeting what we wanted to accomplish, we're still reducing the risk, yet, is that a fair?
In my humble opinion, yes. You are reducing risk, you are taking, there's some movements going around, you can do the simple math around there, but you still have 44% of your portfolio in public equities. And then, it's just a simple add-on. I look at all equities, so I throw private equity into that category. And in alternative 2, that sums to 50.7. How does that compare to where you sit today? That's 56%. So there is a reduction. That's the riskiest part of your portfolio. So there is some of that risk reduction happening.
And alternative 2 looks like, at least statistically, it's got the better compound return numbers than the others, and better Sharpe ratios across the board, pretty much. Yeah.
Yes. That's true. Modestly.
Yeah.
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 Yeah, and this is all about modest moves.
It's all,
Right.
yes, agreed.
very
That, fair observation.
I have a question. I also find alternative 2 appealing, but I want to ask about alternative 1 because I think made clear to both BAM and to Rokaton, I understand the need to de-risk and to lessen the public equity exposure, but I don't want to go overboard, whatever that means. So on alternative 1, I have a question, which is, and I don't have your capital markets assumptions in front of me, but I assume you guys do, which is, the decision to increase high yield and lower OFI. And as I recall, OFI has a substantially better Sharpe ratio than high yields. At least I know it does with some of the consultants. I'm not 100% sure if that's true with Rocaton. And since there's so much room in the basket under alternative one, I'm wondering why we wouldn't keep high yield even and at least put another percentage into OFI. I know OFI is allocated at 5, but we don't have the actual investment isn't even close to 5. I think it's less than 3, if I'm not mistaken.
It's in the mid to high 3s.
It is?
Yeah.
Okay.
John, there's money that has been allocated but not called.
I see.
So when the actual allocation numbers that you see don't show that uncalled
I see.
capital yet.
But then, if that's the case, then reducing it to 3 would require us to actually pare back the portfolio. Whereas if we, and again, I don't
Yes,
know,
you're correct.
I don't know what effect it would have. All of these are fairly close, as Dave just pointed out, in terms of Sharpe ratio and expected return. But I'm just curious as to why not keep the high yield where it is and allow for some further growth in OFI, which has better. Does it? Am I right that it has better Sharpe ratio?
It does,
Oh,
just
yeah.
because of, you can do this as good as me, probably better. Yeah, so we model it as high yield plus 3%,
Yeah,
which is, circulated on the objective for high yield, but also, the expected return premium.
Yeah.
So the vol's the same.
Yeah.
We recognize these are technically illiquid vehicles or more illiquidity, so you'd expect a premium, but that's really, it's how much do you believe in that?
And the correlations are also similar, I
The
presume.
correlations are similar as well, yeah.
Yeah. So then, what would be the rationale for
It's modeled as high
reducing
yield.
OFI and increasing high yield in that case? Joe.
I think that's a fair point. I think if you look at if you were to increase OFI at the expense of high yield in alternative one, if that's the question or the suggestion, it would improve. It would improve the Sharpe ratio.
Yeah.
It would.
Yeah.
That's fair.
Okay.
That's fair because correlations actually, because it is modeled as high yield plus 3, correlations with all their asset classes are identical.
Yeah.
Volatility is identical. It's just we're getting 3% more. Sometimes when we run these for your portfolio, OFI gets crowded out because of the basket, but that's
Right,
not the case.
in this case.
It's not the
Right.
case for
Right.
alternative one. So that's
Right.
That's I was going to add that it's the basket really that's driving the difference between, where you see a 3 and a 5 is how we're allocating basket assets, because 95% of high yield is OFI is assumed to be in the basket.
So we have capacity within the basket, so.
Yeah, so for alternative one, we have capacity.
Yeah.
You could have a alternative 1 prime or 1A, whatever you want to call it, which would take money out of high yield and move it into OFI.
But isn't that alternative 2?
Yeah, it's, yes. So in alternative 2, we accomplish that, but at the same time, the real question is, what do you want to take US equity down to? That's
Right,
really
and-
the
right,
question.
And I would be more comfortable with a smaller reduction in the total equity from 50 to 46 than from 50 to 44. And from a risk perspective, it seems to me that if we did that little switch, my guess is that the risk, the Sharpe ratio would be pretty close. I mean, it's pretty close now.
Can I ask John a question? Just when you said that you'd feel more comfortable going down to 46 rather than 44,
Yeah.
what do you base that on?
So, look, I understand that there's this Rocaton view and BAM view that equity markets are, especially U.S. equity markets, are fully priced, and you expect things to not perform as well. Of course, everybody expects not to perform as well as the last year, but to perform less well in the next decade than they performed in the last decade. Given our status as long-term investors, I'm very reluctant to see us take a lot of equity off the table. A little bit I get, and I also get, the expansion of investment grade fixed as a risk mitigator. But I think as long-term investors, we need the equity exposure. The markets are going to go down, but they're going to come back up, and that taking too much equity off the table is a mistake for us as long-term investors.
But if we make this move now, I'm just wondering kind of like implementation and timing. We're taking some percentage of equity off the table for, this this version of asset allocation, which isn't forever. It's not fixed. I'm not saying that we're like timers, but the idea, I think it's, usually to sell high and buy low. So, we would be selling when things are at their all-time high, and then there's an opportunity to get back in. It's not saying that the equity exposure has to be, 42% for the next 100 years.
I understand. I think that our strategic asset allocation should not underweight our equity exposure. We are already underweighting our equity exposure through the rebalancing that BAM has done. And you say at an all-time high, BAM has gone essentially to the bottom of our rebalancing range, or very close, for the last year, 2 years, right? Because of the view that the markets were overpriced. And yet we gained 30% last year. So, again, Monday morning quarterbacking, but had we not done that, we would have a lot more money in the bank. And I just fear that if we really, look at a 6% reduction in U.S. equity, that we're not market timers, and that to me is a market timing move. A small reduction I am comfortable with, but a larger reduction I feel like is market timing.
And how long does it take to achieve a 6% reduction? Would we just do it all?
Once the board adopts strategic asset allocation, BAM and Rokaton have to come back to the board with an implementation plan. In that implementation plan will be some recommended speed or over number of quarters we would execute that. And to John's point, we don't know where things are going. We're not going to pretend to do that. So my best guess is we'd probably do that over multiple quarters.
I mean, you could actually do it as quickly as, you could do it relatively quickly, but the more typical process is to take several quarters and minimize regret.
Mike, what's our U.S. equity exposure absent the placeholders now? Do you know?
It's a little bit higher than what the target is because of placeholders.
But if
No,
you
I'm
did
saying
have
without the placeholders.
Oh, without the placeholders, we're right on target. So I want
We're
to
29?
make one correction to one of your comments about our tactical tilt. Yes, we tilted the portfolio underweight equities, a little over 2%. In the middle of 18, I'm guessing.
Okay, so
we bought back 3/4 of that, 1 percentage point on December 29th with people in 4 different countries. We were able to execute all
December
that.
29th, a month ago, you mean?
No, a year ago. When the
year
market
ago.
was on its lows. And then we invested another 0.5% in international equities in February of that year. So while we have the results of that part of our tactical tilt have hurt the aggregate portfolios, it's less than what you represent.
Okay.
I want to make that clear.
Fair enough. It would be actually useful to get a report on how much the tactical tilt, if we were at policy instead of underweight, what would what would the marginal effect be on portfolio? Like, I'm guessing. I have no idea. I'd like to know. Thank you.
And we owe you that. We owe you that. It's a work in progress.
So Robin, we do this every 36 months, is that when we look at this?
Yes.
So what if as we start reducing it, what if we do it sooner? What if we, go towards the 25% and look at it at 18 months? And then, is there any harm to doing that?
Well, there's certainly no harm, and the benefit could be, we're very concerned about risk, we're very concerned about volatility. Our sense is that markets have overreached for a variety of reasons, and the one that Mike has cited many times and we believe is we also believe is at the heart of this is, central bank pumping huge amounts of liquidity in the system, which encourages investors to reach for risk. So that could continue for some period of time, or there could be other events, or our expectations could come to fruition. So I think certainly if we adopt alternative 2, I would like to come back to the board. We would come back to the board on a regular basis anyway, and as you know, Mike talks about market conditions at every SIM. But we could certainly come back and say these were the assumptions we made. This was the premise that we based our assumptions on. Here's what's transpired, and we can certainly come back and relook at things in 18 months, particularly if our worst concerns were realized and markets sold off significantly. We would not wait for 36 months. We would come back to you. So this is not about market. I just want to be clear. We have no illusions that we can time markets or that we can tactically trade in a significant way. But nonetheless, to completely ignore current market conditions or not to take them into consideration when they seem to be at extremes, we think is not wise either. And that's why we go through this exercise.
It's more of it's probably more, I'd characterize it as a medium-term view as opposed to, it's not a 1 year, we can't make decisions based on a single year, but 3 to 5 year view would be, we think this, alternative 2 or any of the 3 we just discussed would be preferred versus where we are today. I'd say one quick note on alternative 2, John, just to your concern, valid, is a partial offset to the reduction in U.S. equity is an increase in the target to private equity, which is not public equities, but it's probably more U.S. focused. It clearly is more U.S. focused, and it is equity, and it's certainly a place where you can take risk and generate significant returns.
It's a high beta form of U.S. equity.
And the truth is, that takes so long to invest that the placeholders will be in the Russell 3000.
That's exactly right. So
what's our current private equity
100%
exposure?
invested.
100% invested, not just
I think
committed.
you're at 6, right?
Yeah.
You're at 6%, pretty much.
Yes.
Yeah.
Right
So,
below 6.
so if you went to a target of 7, the balance of between 6 and 7 that's not invested yet would be held in U.S. equity.
I get that.
Public equity. So.
In some ways, I mean, I support that. I think that doing the increase in private equity makes sense. So I get that means that effectively, that the total equity exposure goes from, as you said, 56 to essentially 51 under alternative 2.
Yes, and 52 in alternative 1.
And 52 in alternative 1, right? And I mean, let me just point out that we're also reducing in alternative 2. Well, not by much. I guess only by. We're reducing the international only by what I guess 0.3% total. Right. In other words, the international equity goes from 10 to 9.6 undeveloped. Goes up.
And that is a basket issue.
That's a basket issue,
Yeah.
right? I get that.
And the other thing I wanted to share, I had to update some of my graphs for a meeting in Albany on Tuesday. If you'll recall the graph that I've shared with you all, the GSAM one with the equity market divided into deciles.
Yeah.
We have not moved into the 10th decile. So the statistics associated with the 10th decile, and this is...
I would say congratulations, but that's not good.
This is historic. It does not predict future results.
Necessarily.
But in the previous experiences when the equity market has been in the 10th decile, its average return over the following 5 years is 0.2%, and 32% of the time, each of those years have had a positive return. So the corollary, 67% of the time, the market's had a negative return.
In each of the following.
Each of the following years, yes.
And just to give an idea about the future, because you've been talking about, when are we going to look at this again? There is a memo that was distributed this morning, and it's a memo that my office prepared based on what the next 5 years could potentially look like if some of these portfolios were adopted. baseline scenario is the first row on top. That's obviously if we earn the 7% for the actual rate. And this chart tells you what the dollar change in the cumulative 5 years, for the next 5 years, will be if certain portfolios were adopted, and what the funded ratio will be at that time in 5 years. So if we earn 7%, we're going to see an 83% funded ratio in 5 years. There's a current asset allocation that was given to us from Rokutan, and these don't necessarily look like the numbers that are in the presentation, because the numbers in the presentation are 5 years and the 10 years. But the 5-year analysis is if we just took the first 5 years, and because the rest of the years 6 through 10 were at 7%, we just said, because the city plans on 5 years, the first 5 years is more heavily weighted anyway. We looked at a 5-year return. And the proposed asset allocation, we took portfolio alternative number 2. But if you do look at the returns, they're within 0.2 basis points of each other. So, again, this is to provide you an idea. So I don't think it deviates much if we choose either of the alternatives. So you can see that in the 95th percentile.
Sure, may I stop for 1 second?
Yes.
Which portfolio was calculated? Was it the initial recommended, alternative 2? Do we know?
For the baseline.
Mike, for the analysis that was given to the Office of the Actuary, which was the recommended portfolio?
I believe it was.
Alternative proposed was alternative 2 is what.
Was it
That's
alternative
what
2?
Chair said.
I believe so, but I can double check.
And
Well,
that's
sure.
where it says proposed asset
Yeah.
allocation
Yes,
is alternative
yes.
2.
So I think you're
It's
correct.
alternative 2. I don't
It
think
is
it's the same
alternative
alternative 2 as this.
I can confirm that right
Tom.
Okay. And again, even if it's not,
see
it's very, if you look at
Thank you.
Rokutan's slides, the returns are within, 0.2, 0.1 basis points of each other.
Right,
So
right. This
it's
is
not going to vary.
Yeah,
Sorry,
yes.
sorry.
Yeah.
Sorry.
So, looking at the proposed asset allocation, if we earned the, 12.3% on an annual basis for the next 5 years, the contributions will decrease $1.4 billion for the next 5 years.
So let's do that.
And that would increase the funded ratio from 83% to 104%.
What's the funding ratio today?
About 76.
Yeah, 70, it's on the front page.
Oh, it's on the front page.
76%. It's on the front page.
Of course it is. 76.
76.
76. So the 83% is 5 years from now, and all those funded ratios are 5 years from now. So that's apples to apples comparison.
And what's that 106%?
That we would be
And
overfunded.
we earned only the 5th percentile, which is on an annual basis, negative 1.4% for the next 5 years. The contributions would increase over the next 5 years, $2.5 billion, and it would drop the funded ratio to 51%. So you can see even in the 15th percentile, we're going to have, it's not projected on the expected basis that we're going to earn the 7%. So there is some thought that forward planning that this board should think about in terms of the current actuarially assumed rate, which is at 7%. That is obviously a legislative process that needs to be discussed and gone through in order to change that. But it is something that this board should think about, especially if we can't attain 7%.
Comment? One of the things that's interesting to me about this is how the difference between the current asset allocation and the proposed asset allocation is, actually pretty modest.
It's like 50 basis points. on
I
the
mean,
expected
depending
case.
on-
I guess that can allay your fears a bit as far as
Well, yes,
round to go.
you could say that. I mean, what's interesting is that at the 50th percentile, that's the biggest difference, really, is at the 50th percentile that the current asset allocation generates, 40 basis points more. The extremes are more, less extreme.
But the impact on contributions, if you think about it, is $100 million between the expected case with the current asset allocation versus the proposed asset allocation. So if you take $100 million over 19.4, that's about 50 basis points
Well,
difference.
the difference, what we were given from Workers' Comp was 6.7% compounded versus a 6.1% compounded for 10 years. And for 5 years, it's 5.5 versus 5.1.
So
Wait, what did you do? I don't understand that. You did 6.2 versus 6.1?
That's based on the 10-year compounded.
But the
Because
you're
for
but
Workers'
the,
Comp, they used 7% for years 6 through 10.
but they're actually at 6.2 and 6.2 according to this chart in terms of the. Or you're talking about their original capital markets expectations.
That was provided to us, yes.
This shows no difference for the 10-year expected return.
But Sherry, would you agree that I think with these, so thank you for this, and what I take away from this is that the difference, like any single action we take with regard to this portfolio, it's very large. We don't take, we evolve, we don't take revolutionary steps, and so there are very modest differences among.
I think they're modest amongst the portfolios.
Yes.
But I think also we have to keep in mind that when compared to, which has nothing to do with,
The decision we're making today, yes.
7% that's
Yes.
assumed, that is, $500 million over 5 years.
Yeah,
It could be potentially,
right.
even at the 50th percentile, even more if we don't earn that, obviously. So I think that's another point to, within the portfolios that we're choosing, or the board is choosing, I agree with your statement. But, just a step forward, the next step that the board should think about is also, what are next steps? Now that you know that your portfolio in the 50th percentile is not going to achieve the actually interest rate, we should think about calibrating the assumed rate so that our assumptions match what our portfolios are doing.
Well, can I ask you a question? When you think about setting that 7% actuarial rate of return, what period of time, over what time horizon should we be thinking when establishing that rate of return?
And it is a longer term. I mean, 10 years could be something that it's held for, not helpful, but the study is done for, right? Because I think, if you look at the money weighted value of the liabilities, it is very much weighted on the first 10 years versus the 30-year time horizon. I will say that we don't have, it's not like we only have one opportunity every 10 years to change it, right? So our the discount rate that's set in state statute, it was set for a period of, let's say, like 5 years before, and then it sunsetted. And when it sunsetted in law, the actuary made proposals to keep it at 7% for a 1-year term. And every year we were renewing it, but then we had discussions with the city and said, why are we doing this every year? We should think about a longer term. So this past fiscal year, this current fiscal year, it's now in state statute for 2 years. So it's this fiscal year and next fiscal year. So the 7% is due to expire next June of 2021, June 30th, 2021. That doesn't preclude us from going to the legislators to change it if we feel that we should change it. But that's just the legislative process.
If the 4 other systems have expected returns that beat the 7% legislatively, what would you do with that?
They are, obviously the statute and state statute is different for each retirement system. So it doesn't necessarily handcuff us to having the same discount rate for all the retirement systems, especially if there's different decisions made by different boards and different risk tolerances from different boards.
Thank you.
Just one point, which is that if you look at the adjusted expected returns, and for the most part, the volatilities are the same,
Yes.
but the adjusted returns
Well,
obviously.
we continue to use our volatility.
Okay, so
that's why it's the same.
Oh, that's why it is.
Yeah,
So you didn't do a consensus volatility, we just
Right.
did consensus.
And I think the
return
volatilities weren't
expectations.
materially different.
Okay,
It was really the
right.
returns that were very different.
Anyway, one of the things that strikes me that's useful in this exercise is that, not only at this board, obviously, we've been using the Rokutan capital markets expectations, and at each other board, we're using theirs. But if you look at the consensus, then these expected returns are all right at 7%, around the margins of 7%. So
For 10 years. Yep.
for 10 years,
Yeah, for the
right,
10-year
which is the
period,
period I
right.
think that Sherry suggested.
Right.
So that would suggest, when you that would suggest that 7% actually might be the appropriate discount rate, and it might be something. I guess it might be something we do at the other boards too. Is look at it using consensus as opposed to that specific thing, for the purpose of figuring out if the discount rate is on target or not.
But the consensus number doesn't include Rogaton.
That's right.
If Rogaton was included,
That's true.
It'd be a little
then
lower.
it would be a lot lower.
That's a good point. Very good point.
Okay.
I'm sorry, can you go over quickly the difference between those two columns, the green?
So the green uses capital market assumptions. They're the average of the 4 consultants for the system, excluding Rokutan.
Okay.
Because there is a difference, particularly in our US equity expectations. So the board was interested in seeing what the expected returns for each portfolio would look like if we excluded Rokutan's more conservative expectations from the analysis.
And then the blue is just Rokutan.
Just us, correct, just Rokutan.
Okay.
Can I just ask one teeny tiny question about
As long
alternative
as it's
one?
teeny tiny.
Yeah, it's teeny tiny. The thing that jumps out is that if you look at the total public equity across the board, 50, 46, 43.7, and 42. And then high yield, you go to 5.3. Like, why is that 0.3 in high yield and not in US equity, or in public equity?
I think, I believe it's a basket issue. That would be the most logical, because,
Around the international stuff.
yes, yeah. It's international counts towards basket, high yield does not.
Most of high yield does not.
Yeah, I mean, yeah,
20% of high yield does, but that
yeah,
that
but
makes some sense.
it
If-
seems like it's, those odd, I usually attribute those odd,
To a
non-integer
basket,
results
shoehorn.
to basket,
Yeah.
because the modeling tries to take into consideration the optimal portfolio at certain, given certain constraints, and the basket's one of those constraints, so it just pushes things around.
And the basket, you guys have recommended that the basket not go all the way to 25, which is what we did last time,
Correct.
but go to 24, more or less.
More or less.
Yes, the basket's not a target, it's a ceiling.
I understand.
So when we get above 25, the rebalance committee has to take action to get it back down under, or Alex is in trouble.
The basket police is gonna take them away in handcuffs. Right, we talked about that. Okay.
So we thank Rokutan and BAM for creating this with all the alternatives. Does anyone have any other questions about it? Are we ready to take a vote on this, or?
I would like to, I'm not quite ready to take a vote. I'd just like to consider this.
So what else do you need? What
Well,
else
I
do
just
they need to
need
do?
a little time to
or-
marinate in it. I think this is like a huge decision that we're making. This is like the most important decision that trustees make.
It
So
absolutely is.
I guess I would propose that we take a little bit more time to consider it, and then we can vote at
We can add it to
board
this
meeting or
February
the
sim
February
agenda.
sim.
The caucus.
I won't be able to be at the sim. I had notified you, so if we could do it at the next,
At the
at
board
the
meeting.
next investment meeting, or next board meeting.
Or at the
So we're
next
looking, so we'll just review what we're looking at. So we're tend to be looking at alternative 2. And what did we think about the 18 months coming back? Mike, did you weigh into that, coming back in 18 months instead of 36, and seeing how that's going? Is that a possibility for you as well, or?
Absolutely, and I would also encourage the board to charge Rokutan and BAM with, in addition to the strategic review, which is generally every 3 years, to review it yearly.
Oh,
To review it yearly, I think that we would be
Yeah.
happy.
It's
to-
good practice.
It's very
So
so charged. So charged. Okay.
May I also just follow up on, I think, what John was asking for, if it's possible to get that analysis of the placeholders and the sort of opportunity cost of not having the full allocation in the private markets? It's just to get a sense of,
Just make sure I understand what you're at.
well, I think what, just aspirationally, we're at, not at target, correct? I think you said.
For
the
private equity. So private equity is at target.
Okay.
It's public,
It's talking about the,
Underweight the public.
the
Public?
underweight. Yeah, I think what you're saying is that we are not, we have, within the rebalancing ranges, you've done a tilt. And so what the opportunity cost has been of that
or
tilt.
the impact. It's not always been an opportunity for us,
Just
but
the impact, just to get an understanding of the difference between the numbers and the numbers, as it were.
Well, can I just add, I just want to make clear that, the rebalancing, so the board tells BAM, this is the target, plus or minus 1 or 2 percentage points, and that becomes the rebalancing range. And BAM keeps everybody within the rebalancing range. Maybe not, it might be impossible to be exactly on target all the time, but BAM maybe has, done certain things to keep us at the high end or the low end, but we're within the ranges. The board, the fund is in the ranges that the board has approved and charged BAM with staying within. So there's no bad or,
No, that's not true. There are bets, but
no,
it's within the range.
it's within the range. So I don't think anybody here can say, we're requiring you to be exactly at 29 all the time. We're saying we know that the way things work, you could be at 29.2 or you can be at 28.4. Sort of things come back and forth. So we're within the ranges. So when we talk about it as opportunity costs or having lost money because of bets, we're just doing what the board has told us to do, which is to stay within these bands, and they're using their best professional judgment to say, I'm gonna stay within the band, kind of on this side or on that side, but we're within the bands that the board has required us to be, and I just think that needs to be made clear.
That's clear, but within the bands, the staff does tilts.
The staff uses their judgment, that's what you want staff to do.
I understand, I'm just stating that they're tilts.
Totally, but I just think that it's really important. It's like, we don't want the board to have to micromanage every single decision.
Absolutely.
What we're telling our investment advisor to do is to have this target and stay within these bands. Every sim, Mike shows the little lollipop chart about, how close to the band that we're in.
Bubbles, not lollipops.
It's just those bright colors. So, just like in thinking about it, it's like, is it the board's job to kind of, make the determination and then say, okay, within that determination that we've told you to do, you're doing it, but why are you doing it, like this shade of gray rather than that shade of white?
Well, I think all we're at,
Did you still need something? It answers my question. It's just when we're looking at alternatives here, and it's, the difference of 0.1%, and then I'm wondering, how does that reflect how the allocations are actually being made? And so it seems ridiculous to be splitting hairs here, and then that's all.
And we'll certainly give you the numerical analysis. The crux of the placeholder assets that are deployed are because of under-deployment in real estate. That's where it is. So private equity is fully deployed.
Okay.
There's no placeholder assets associated with that. It's real estate, which we've talked about at various different meetings, but happy to show you actuals.
Right. Good. Okay.
I'm sorry, just 2 more points. First is that, let's also remember that BAM came to the board a few months ago and asked for those ranges to be doubled. And we decided to delay that decision until after we do our asset allocation. So that will be another important decision that we have to make once this asset allocation discussion is complete. Secondly, I just wanted to ask Rokadan, could you come back with the calculations on making those changes on alternative 1, where you reduce high yield by run 1% and increase OFI by 1%, just so we can see what that does to the numbers? Great, thank
Are
you.
we looking at alternative 2? Is that where were you asking us?
I was asking for alternative 1, so we have to.
So you wanna see what alternative 1 would look like, high yield at 5 and OFI at 4?
Exactly.
I don't think you'll be able to see a difference, but we're happy to do that.
Great, thank you. That one can be a comfort with the direction the board is taking here. Thanks.
Okay. All right.
If I may, in terms of timing, I would encourage the board to think about the following. The outcome of the November election is potentially very important to asset markets. Very simply, if Trump's reelected, the market view is that's positive for markets. If a Democrat is reelected, it depends whether it's a Democrat who's more progressive versus one who's more centrist is important to the markets. And I think the other consensus view within markets is the equity market hasn't quite been able to think about those probabilities because the Democrats don't yet have a candidate. And on March 3rd, 37% of the delegates get assigned. I'm not saying that could be the tipping point to when there is a candidate, and then the markets are going to have to wrestle with versus re-election or whoever that candidate is. Potentially an important day for markets. When that candidate becomes decided upon by the party, it's going to roughly be 50-50, and most people think that that's probably not positive for equity markets. So just bear that in mind as you're going through your time.
Okay.
Well, we're not market time.
So I think we
Move
decided the
10 to
next
20%
meeting,
one at a
the
time.
February 27th meeting, is that when we'll make this decision?
After March 3rd.
Or you want us to do it after March 3rd, is that what you?
I think before, he wants before.
But even if you do it at February 27th, you're not gonna take any.
The market's gonna be,
I
I'm
think
gonna ask them
we
a little
will be
bit
decided by
March 3rd, right?
by February 27th. We're almost ready. Correct, John just wants you to tweak one little thing, and then we'll be ready to take the vote, yes? Okay,
Sounds like it to me.
all right, so we'll put it on February 27th agenda. Great, is there anything else for public session? All right, then we need a motion to move into executive session.
I move pursuant to Public Officers Law, Section 105, to go into executive session for discussions on specific investment and litigation-related matters.
Thank you, Mr. Brown. Do we have a second? Thank you, Mr. Buckley. Any discussion? All those in favor? Aye. Thank you. Any opposed? We are in executive session. Thank you. Welcome back to Teachers Retirement System. We are in public agenda. When we spoke before, we said that we had an emergency item that was added to our agenda, the Galeno implementation budget modification. Okay, so we have a resolution for the Galeno project.
Okay. Whereas the Teachers Retirement System of the City of New York must comply with the court order awarding pension relief to Galeno litigation class members, and whereas TRS has started to work to implement the Galeno pension order, and that work will continue through and beyond the end of the current fiscal year, and whereas the total TRS fiscal year 2020 budget previously approved by the TRS Board of Trustees, including the modernization budget, did not include funding to perform work necessary to implement the Galeno pension order or account for the impact of the order on the modernization program and budget. Therefore, be it resolved that the Board of Trustees hereby approves a modification to the fiscal year 2020 budget by increasing the agency budget in the amount of $4,322,629 with an estimated $2,788,000 attributable to the variable program expense fund and an estimated $1,534,629 attributed to the employee's administrative expense contribution.
Thank you. Is there a motion to approve this resolution?
So moved.
Thank you, Mr. Kazansky. Is there a second?
Second.
Excellent. Is there any discussion?
Yeah. The mayor, myself as the mayor's representative, opposes this resolution, at least today. I feel that we have not received sufficient documentation to support the spending of this amount. Feel that we really don't have a full enough sense of the analysis that has been done and alternatives to including this program in the modernization program, and therefore we're not going to vote for it today, and my preference would be to table this resolution for today. So with that, I'll make a motion to table the resolution.
Is there a second?
Second.
Thank you. Any discussion about tabling it?
I'd just like to say that I think tabling it's an unnecessary delay. There's work that needs to be done, and I'm not in the place to insert myself into the day-to-day operations that TRS needs to do this work and comply with this litigation. And the sooner we get it started, the sooner we can get the Galeno class members their settlements. So I am against it, and I would hope that we can move this forward and vote on this today.
It should also be noted that there is a budget committee, and the budget committee had an emergency meeting on Tuesday, and
Yeah.
It's my understanding they were brought up to date on some of these matters as well.
Yeah.
Okay.
Who was at that meeting?
So members of the budget committee are?
The controller's office.
Controller's office was there, John was there, I was there, OMB, Patricia,
System
Thad,
staff.
TRS,
Okay.
That's all.
All right.
Bob, of course.
Okay, so we're going to take a vote on if we want to table it. So the motion was made to table the issue. So all of those in favor of tabling this item, please say aye.
Aye.
Okay, so we have three. Okay. All those opposed, please say aye.
Aye.
Okay.
Well, nay.
All right.
Oh, the ayes are unanimous.
Any abstaining? Okay, so we have what is necessary. We have someone from the team.
You do. You have,
So we have
the
the
motion
vote.
to table the
Fails.
resolution failed.
All right, so now we're going to take the vote on,
Before we do,
Sure.
Madam Chair, if I could just add, on the original discussion on the resolution, the controller's office perspective is definitely one of concern of the large amount of this cost, but some of our concerns were alleviated and addressed in the information that we've received from TRS, as well as the lengthy discussion and the details that we received at the budget committee meeting the other day, in terms of going through the steps necessary and the scope of work required to process this special class of people in the midst of a modernization and having to create that system in sort of two different functionalities. So in discussing this internally, the one request that the controller's office has going forward after, if we're able to approve the budget bond today, is that we have an outside set of eyes, some group that is familiar with TRS operations and the modernization project, and could take a look at the plan going forward, because we're at the very beginning right now, and maybe just give the board some more information on whether the approach makes sense and if there are any tweaks that can be made. And so my office is suggesting Marks Paneth. TRS staff had suggested LRWL, and either of those would be, I think, fine and could really be a positive contribution to the discussion.
okay, thank you. All right, so we'll take a vote. So just to remind everyone, we're taking a vote on approving the modification to the fiscal year 2020 budget with the understanding that there will be another set of eyes looking at this again, either someone from LRWL and or the auditor Mark Spanis, and they will make suggestions and let us know how they're doing with this modification. Okay? All right, so is there a motion? Do I have to do the motion, Ken? So is there a
motion second.
So we've already, okay, so we go, so all those in favor of this, please say aye.
Aye.
All those opposed?
Nay.
Okay, anyone abstaining? All right, so then we can move forward with this, so it's been approved. Good. Okay, any other items? So now we have a report out?
Report out.
Sorry, Ron.
In the executive session of the passport funds, there was one manager update. There was a presentation from an emerging market manager. Consensus was reached and will be announced at the appropriate time. And lastly, a litigation-related matter was discussed.
Okay, thank you. Is there a motion to adjourn the meeting?
So moved.
Thank you, Ms. Vickers. Is there a second?
Second.
Thank you, Mr. Brown. Any discussion about it? No? All those in favor?
Aye.
Thank you. Any opposed?